All right, let's start. I want to do a quick review of papers 2, 3, and 4. Make sure you're ready to go on those. We're a little bit behind in the class, but I think we'll be all right catching up on valuation. So paper 2 is your company paper. It's a little bit open-ended, not quite as much as paper 1, but describe your firm, main products, main customers, just give you a sense of who the firm is, geography, market share. I've seen some of your papers and y'all done a good job of capturing that. History, high level. Make sure it's useful and valuable. Don't throw something in just to throw it in. So think about the history, what really is important to this company. Sometimes it's a change in CEO if there's a really, really critical CEO, but if not, no one knows who the CEO is and it doesn't matter. Figure something out. Major acquisitions can be important. Just going overseas for the first time, those kind of things. Amazon buying Whole Foods, it's obviously a big one. So those type of things. And then you get into who is this firm? What's unique about this company? What distinguishes them from other companies? So get some sense of who they are. And then senior management, this is where I encourage you, go on to YouTube, find their CEO, listen to them. What are they saying? I don't like, and I get it every single paper, I don't like the 5 or 6 just management bios. Being a bio, I don't really care where they went to college. I don't care where they worked before unless it means something. I do care about management's expertise. So if they're running Exxon, I want to know if they're a petroleum engineer or if they're a Harvard MBA. If they're running a tech stock, semiconductors. If they're running a pharmaceutical, are they a research scientist? Who are they? What's their background? That to me is pretty important. And ESG can certainly be an important discussion, and I gave you, that resource you can use. You've got Bloomberg has something on that. That's not going to be. You're not going to find that in example papers from previous classes because they just didn't do it. And then some type of economic mode discussion. What is about your firm that gives them a distinctive advantage? This is going to be really important when you get to paper 5, and you have to come up with growth rates for your firm. And we talked about economic moats earlier, and it's this thing it's an advantage. It allows them to charge higher prices. It's sustainable. The competition can't copy it. And why can't the competition copy it? What exactly is it? Is it a brand? Is it some type of expertise? What is it? Think about that for your firm. Not all of your firms have that. So, there's a chance your firm is just in a commodity business and is just struggling to make that work. But, still talk about that. And then a SWOT analysis. Think about your SWOT analysis compared to what you did with Porter and try to relate those two. Usually strengths and weaknesses are very company specific. Opportunities and threats tend to be more industry related than company specific. So think through those connections. And then some final conclusion on this firm relative to their peers. And be honest. This is the paper students start becoming advocates for their company. You can't do that. You've always got to be objective, step back. What do you honestly think? You don't have to like your company. The purpose of the paper is not to get people to buy the stock of your company. It's to give an honest assessment. So if you don't think they're a good company, my guess is you picked a company because you like them. So you probably came in with that bias anyway. But if you're starting to say, man, I'm just not sure they have anything that distinguishes them, that really gives them any advantage, then put that in the paper here. All right, that's paper 2. Can y'all handle paper 2? It's a good summary of the company. Make sure you've read the business description section of the annual report. You hear what management says this company is all about. Make sure you've done some type of value chain analysis, research in Google to see what other people are saying. The value chain is highly related to economic moats. So go along, essentially the value chain just says, what does this firm do? Step by step by step. inputs, process, outputs, staffing. What do they do? And of those different pieces, where are they most distinctive? What gives them the huge advantage over everybody else? So I think it's interesting listening to Cinnabon. She said one of her distinctive advantages was the team that does the mergers and acquisitions and licensing, that they're just really good at understanding the franchisers, what they need and all that. Well, that's pretty impressive. That's a staff function that they say gives them an advantage. All right, so y'all good for paper 2? Anybody finished paper 2 yet? I think I've seen a couple pretty close to final. So if you interview with a firm that you did paper 2 on, they'll be really impressed because you're going to know the firm better than anybody else. Paper 3 is paper 3. And I've already written it for you for Walmart. All you got to do is edit it for your company. So, and some of y'all have already done this before with me. So it's just a matter of going through. This is one where if you just cannot figure out your company, we're looking at bonds. Boy, Costco is so strange because it looks like their liquidity got really bad in 1 year and then improved, and it's the exact opposite. The year looks bad, it actually got better. And it just has to do with the divisor. You're taking working capital requirement over CFO, and both of those were changing and just caused some noise. So sometimes you have to just explain away what's going on with the accounting. So they're not all easy. I've been trying to figure out, how do you talk about the net working capital? And I like to divide it by CFO so I can somewhat see how it's growing versus the size of the firm. But you get those noise things in there, and it's stuff that has nothing. It's the same thing with times interest earned, right? Times interest earned can rocket down, not because they took on a bunch of debt, but just because the earnings just dropped dramatically for some completely unrelated debt. So you always have to look at the numbers and see if there's really something going on that has nothing to do with what you're measuring. But yeah, those are the pieces. I say final conclusion statement, but what I have in Walmart is sufficient. So there's nothing that you need to do in paper 3 that's not in the Walmart example. So if you edit the Walmart all the way through, then you have everything you need for paper 3. All right. And again, if you have a question, highlight what you have a question on and email it to me. Don't email me your paper and say, great, I'm not going to grade your paper twice. I'm as exhausted as y'all are this time of semester. But if you have specific questions, then yeah, you're welcome. I'll come by my office hours. We can talk about it. And then the forecast, we're getting to the point of semester students are starting to say, man, I'm getting a little behind. So I would recommend make sure you get papers 2 and 3 done. And if you're a little late on paper 4, that's not a disaster, because 5 and 6 are, boy, I kept changing. Get 2 and 3 turned in. If you're a little late on 4, that's fine, because 5 and 6 are not that as difficult as papers. So you can, but what you need to focus here on is have a really good discussion of your revenue, because that's 50% of the paper, and that is the most important thing. If you have a good revenue forecast, you'll probably have a good forecast. I mean, it's possible you could mess up somewhere in the forecast, but if you have a bad revenue forecast, nothing else matters. If you're like bad revenue forecast but perfect on everything else, you got a bad forecast. It's just no way to get around it. And then do the pieces of the income statement, margins, high level discussion of balance sheet. So a lot of what you're doing in this paper is most of the work is the Excel, getting the forecast built. So really all you're doing when you're getting to the paper is just explain what you did. So my accounts receivable I did as a percentage of revenue, looking at historical trends. My accounts payable percentage of cost of goods sold, look at historical trends, and it's just explaining those type of things. My debt to equity, whatever you have in there. Other type of analysis that you want to do, other ratios or whatever you want to throw in there, that would be fine. If you want to bring in the Bloomberg forecast, that's perfectly fine. It's hard to say why Bloomberg's forecast is high or low, because who knows who these people are. But if you want to compare that would be fine. And then some key ratios and graphs similar to what you did in paper 3, but not nearly as extensive. So hardly ever on the forecast you're going to talk about liquidity, but probably not too much about solvency, unless debt has been an issue for them. But definitely turnover and margin and return on capital, return on equity. Those are the kind of things you want to present. Make sure you explain the obvious things. So if it jumps up, jumps down, try to explain that. I'm talking about in the forecast. You don't need to do it with the history because you've already done that in paper 3. But if something strange happens with the forecast, have some answer for why that's going on. You can use the Walmart Excel to do your entire forecast. It's somewhat simplistic, but if you do that, make sure you create an entire separate sheet just for the revenue forecast and bring that into the Walmart. But the Walmart is set up for you to do a full-fledged forecast. I can't find Walmart. There it is. And it doesn't take that many inputs to be able to do it. So all you need to do the Walmart use. So once you build your revenue forecast, you plug that in here. And then all you need to finish it is anything in green. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, maybe 20, not even 20 things. So it's a really simplistic forecast approach, and it's based entirely on history. So you just look at the historical and you just plug in things that seem reasonable, and you can just plug in numbers like on goodwill or miscellaneous, just plug in a number just to get you to the next level. All right, so I don't mind you using this one, and I even built the graphs for you. I can't remember how I did this. It's kind of, maybe you have to show this in your class bond, but yeah, you have to get a line that changes color like that. You know, essentially, you have to build a line twice and then make sure this line's on top, because if you don't do it that way, then it's just one big blue line all across. But I like this so you can tell where the forecast starts and the history ends. It's not a bad way. And those that are taking my Costco class, you saw that I didn't wait to build the graphs until the very end. I was building graphs as I went. So I just did my revenue forecast. So, you know, you got it. You can jump over here and look at it. So don't move on off of revenue forecast unless you look at the graph. Don't move off of gross margin until you look at the graphs. So as you go down, and I was just doing that with Costco. Every time I built something, I just graphed it, looked at it, and say, okay, that seems reasonable. There's nothing wild going on there. I didn't click the number wrong. So I do that all the time. Just build a graph just to see if what you're doing is reasonable. All right. So that's paper 4. Paper 4 is what most finance students want because it's majority Excel work. That's what you want to do, right? Sit in Excel. You don't want to sit down and write it out. So here you just at the end write out like you did. But most of your paper will be on revenue. All right. So I forget when this is. Is it due tonight or is it, when is it?
29th.
29th. So you got the rest of the month. Always like to shock students. So yeah, you can finish 2, 3, and 4, and then you got Halloween to go enjoy. When do people start decorating for Halloween in September? That's just the craziest thing. When I was a kid, like we started October 30th. And
I kind of fixated it where the time that Walmart and Target put their Halloween decorations.
Yeah. Where I ride my bike, I don't know about the neighbors, this guy's neighbors, but he's got this really creepy looking guy walking through his yard, and he keeps moving them. And when I ride my bike in the middle of the morning when it's still dark, and you see this guy's got like the hockey thing on, pretty creepy stuff. Yeah.
People are really invested.
Yeah. His neighbors must look out their windows. And I think it moved. All right. So let's get to papers 5 and 6. And paper 5 is the theoretical paper. We're going to stick with theory, what you've learned in other classes. So this is one where you've already learned it. You already know how to do it. You just got to sit down and do it. So this one's pretty straightforward. So we got discount rates. I'm going to skip the prelim, what a discount rate is. And we're just going to go straight to the capital asset pricing model. Anyone not know CAPM? This will just be so second nature. The most famous formula probably in finance, good old William Sharp. I remember taking the CFA exam. I was taking a study class up at University of North Texas. And it was the last day, and these 2 guys in front of me were like, wait, what's this CAPM formula thing? How does that work? I think I'm ready. They don't know CAPM. at this point. And that exam was heavy CAP-M. It was essay in the morning, in the afternoon, it was multiple choice, and my word, they just kept asking CAP-M questions. Sometimes you'd have to plug in these three numbers to get this number. Sometimes I give you this number, you have to figure out this number. I was like, give me about 100 more of those, I'll be fed. I can do algebra. Really straightforward. So it was heavy on that exam. Right, so I don't know why it says 5 there, but you need three numbers. That probably has to do with inflation. So a risk-free rate, beta, and the market risk premium. Risk-free rate and market risk premium are the same for all stocks. So when you write paper 5, 4, like 2, 3, 4, 5, when you write paper 5, if you wrote it 100 times for 100 stocks, the only thing that would change would be the beta. Everything else would be the same. You don't have to change that. Now, I know some of y'all have done Damodaran. There are other risk premiums, small cap, international. When ignoring that, if you have a small company and you want to make the small cap adjustment, that's fine, but I'm not actually asking you to do that. Most of your firms are large enough and they're US, so we don't need to make that extra adjustment. But if you want to do that, I mean, the wonderful thing about Damodaran is he shares everything. He's not figured out how to monetize his knowledge. So he's got it out there. He's got the country risk premiums, which is pretty amazing. It's all out there for free and how he came up with it. It's got it by industry somewhere. Let me try. Well, just all our books. I mean, he dominates this. So there we go. Damodaran risk premium by industry. So he provides all this for free. You can certainly quote him or use him if you want to. Where he's really going to be the most helpful is on the risk-free rate. I'm not a robot. How do I confirm I'm not a robot? So, okay, so that's the someone's using Damodaran's name, but so he's a good source to use. He's probably the best source to use just because he publishes so much data for free and he has really good articles out there. So you've got to come up with these essentially three numbers. The risk-free rate is historically, when this first came out, Roger Ibbotson was the guru for the risk-free rate and the market risk premium before Damodaran. Roger Ibbotson, Dr. Ibbotson from Chicago, he started a firm called Ibbotson and Associates. He's really done most of the studies, academic studies on this. And he debates whether you use the short-term treasury, you use the 5-year treasury, the 10-year treasury, the 30-year treasury. And most people overwhelmingly use the 10-year treasury. Short-term rates are way too volatile, so your discount rate will just be going all over the place. And the 30-year treasury is a very supply-demand dependent, very specific market type of bond. So the 10-year is just right there in the middle of the curve. It's very liquid. The problem with the 10-year right now is what? So ridiculously low. Sorry, I can't spell. I can tell that's not right, but I don't know where I messed it up. I don't know if this goes through the day. Yeah, wow, we're up to date. So the 10-year is, wow, it's jumped up here, right? We've gotten up almost 15 basis points, 16 basis points. But 165 as the risk-free rate. Now what Damodaran argues is use the 165, but then your terminal growth also use 165. He argues that your long-term growth and your risk-free rates should be the same. If the long-term growth of our economy is at 1.65%, we're in a lot of trouble. Medicare will be a disaster. So, but he says, well, at least you're consistent because if you use a higher growth rate with a really low discount rate, you can get these massive valuations. So what do you do at this 165? So you do need to address that in your paper. You can't just in your paper say, I'm going to use the 10-year treasury without adjustment and not talk about the fact that it's so low. The problem with this debate is I've been saying this in my classes for the last 7 or 8 years. Initially, I normalized the 10-year treasury. It's like, this is temporary. It's the financial crisis. The Fed's keeping rates low. We're going to get back to normal. But I kept saying that year after year. I've now thrown in the towel. I don't believe in normalizing yield curve. Some of you are going to normalize it because you're going to see it in other students' papers. But I'm just telling you now, I don't like that approach anymore. It doesn't make sense to me to normalize because I don't know what normal is. Japan has been abnormally low interest rates for 2 decades now. We're going on over a decade now. So, what is normal? It seems strange to me that the Fed is targeting 2% inflation and our 10-year treasuries at 165. That just seems really, really strange to me. Especially Damodaran's argument that this number should equate to economic growth, nominal, not real. This should equate to nominal economic growth in the United States. So you're thinking of real growth, 3 to 3.5%, but add 2% inflation on that, it should be. And most of the Treasury's history has been around 4% or higher. That's been pretty normal. The first interest rate swap I did, I executed it when the 5-year Treasury is at 5.16. I remember going, man, I love this rate. Let's execute. Thought that was a really, really high rate. Now I look back and it's like, man, that's just unheard of. Y'all never heard of a 5.16 5-year Treasury. I don't even know if that ever existed.
I was going to ask you, what was the rate?
Yeah, when I did that first swap, I was like real frustrated with my swap dealer because he's, I think I can get a little bit better deal. I was like, no, actually, 5.16, that's the rate I want. So, the 5-year Treasury now is, not even 1.5%, 1.2%. It's interesting that the 5-year is up and the 10-year is down. So we should almost stop and figure out, oh no, they're both up. Sorry, looked at the wrong column, but which one's going steeper? So there's 24. So it looks like the yield curve's flattening a little bit, right? Shorter rates. Eduardo explained it to us on Wednesday, but it looks like the yield curve's flattening a little bit. What does that mean? Flatter yield curve? Is that recessionary? But anyway, so that can be your rate. If you're going to use this rate, you've got to explain why it's okay to use it when it's so low, and that's where Damodaran's going to help you because that's what he argues. You can find his argument for why lower rates make sense. I think I might have given you a link to his article on that somewhere in here.
I think I did.
Yeah, here it is. Yeah, so here's an article. It's a very old article. It's 10 years old. It just shows you how long interest rates have been low. Someone said he's updated that, so you could probably find a more recent one. So my preferred approach is the bootstrap yield curve. And I just think it's somewhat abnormal right now, mainly because we've just gone out of COVID. You got QE, you got a lot of weird things going on. So I like to use the bootstrap. If you don't know how to bootstrap, I have videos that show how to do that. To me, it's not important because of this paper. It's important because you shouldn't graduate without knowing how to bootstrap yield curve because it's a really important skill to have. So if you've never done that, teach yourself how to do that. It's pretty simple. Anybody remember the formula for that? So we said the 10-year is 165. 5-year, I think it was 117. So if someone says, what does the bond market think 5-year Treasury will be in 5 years? Y'all know how to do that? But who knows how to do that? Some of you have done this before. No way? Somebody knows. You may know this, or you've done this before. So what's the formula going to be? 1 plus what? What do you put on top? The 10-year? Do what? To the 10th power? I'm sorry? I was on the bit. Someone doesn't like this approach. You divide that by what? Right, and you raise that to 10 minus 5 minus 1. Is the expected 5-year going to be higher than 165 or lower than 165? It has to be what? It has to be, well, if you're going to invest for 5 years at 117, and you're going to invest at another 5 years at some rate, and over to 10 years, you're going to make 165. So if you invest for 5 years at 117, what do you have to do the next 5 years to get 165? You have to invest much higher than that. So when we do all of that, I don't know what it's going to be, but if you do all of that, turn these people off. Just a second. Who is it? Y'all see? It's what? Here? Ah, ye. Okay. All right, so if we do that, 1.065 raised to the 10th divided by 1.017 raised to the 5th. All of that raised to 1 divided by 5 minus 1. Ooh, I did something wrong. What did I do wrong? It's this one. 117, there it is. Ah, Bill Gates, come on. I always love it when that happens. 1.1.
Hey, Professor, you're not sharing your screen on Zoom anymore.
Oh, lo siento. That's because someone was making noise on y'all side, so y'all keep it down over there. All right. All right, so I've got too many parentheses. Well, 10 minus 5 is 5, so that should work, right? Yeah, I'm doing something, but sorry, I don't know why I got it off here. Well, anyway, that's how it works. Somehow it doesn't recognize that. But that's the approach. I've got some typo in my formula. If I did it right in there, yeah. Problem with that is I get too many spaces. Well, watch my videos and it will. Yeah, I'm still doing something wrong. 213. That sounds about right. So yeah, I've got, yeah, you should never do Excel when people are looking at you. But I really don't know. Well, that's still wrong there. But that didn't fix it. 117. Oh, it's 165. There we go. It's I can't type numbers, but anyway, 213. That makes sense, right? 213. So what does that mean? You're going to invest at 117 for 5 years. And you're going to take that and invest at 1 plus 213 for another 5 years. And what should I give you? That should get you 1 plus 1.0165 for 10 years. It should give you the exact same amount. So that's the forward curve. 213 sounds a little more normal to me because at least it's above inflation. Still sounds awfully low. Essentially, you know, people are trying to figure this out. We got a lot of debt out there, corporate debt and government debt, especially debt tends to be deflationary when it's that high. You know, what's going on here long term, but if we have any kind of short term noise going on because of COVID, at least the forward curve gets you beyond that point. Now, the problem is this is the forward 5-year curve, 5-year, and we want the forward 10-year. So you'd have to figure that out. There's a couple ways you could do that. There is no 15-year treasury here, but you could go find your own 10-year treasury. So there are websites. A 10-year treasury, all you gotta do is find a treasury that matures in about 15 years and get its current yield, and you just use that. All right, so and there are websites that do show. They used to, Wall Street Journal and other newspapers used to have every treasury that existed listed in the newspaper. It's pretty amazing. So that's how we used to get the number. We just go look it up. If you need a 2-year treasury, 3-year treasury, or 4.3-year treasury, you just go find one that matures at that time. I have found the website that does that, but I don't remember where it is. So you just have to look for every single treasury. Someone has those rates because they used to be published every single day in the newspapers. It's amazing that is. Including y'all know newspapers used to publish every stock price too. The high, the low, all that in the newspaper. It's amazing how many pages. The financial section was just massive. All right. So there's a couple of approaches there. You've got to justify each one. So do you use the actual number? That's fine. But put some words behind it, and that's where Dan Modern can help you with that. Normalize it. I don't like normalized anymore. But the normalized says the 10-year treasury should be somewhere in the neighborhood of real and nominal GDP growth. Should give you some kind of real rate of interest plus some expected inflation. We're not even getting expected inflation right now. So that's the normalized. But if you do the normalized, you're going to get a number in the 3.5% to 4.5% range, which to me seems ridiculously too high, given that we've been well below that for a decade now. And then the forward curve is the approach I prefer now, just because I do think we're in a noisy situation with COVID. The nice thing about the forward curve is that you can also get the forward inflation number, which can be valuable to you in paper 6 and some of the valuations, right? So there's the risk-free rate. Another question to ask is the 10-year treasury actually risk-free? And that's when you get into things like matching. And so I like the way Robert Arnott explains the risk-free rate. The risk-free rate is the treasury that best lines up with your personal cash flow, whatever your value. So whatever treasury best defeases the actual cash flow you're doing, which might not be a 10-year, it might be a combination of treasuries, because very few companies have very small cash flows and then a massive cash flow at year 10. So it's from that standpoint, it doesn't really match. But 10 years is the most popular, most common approach out there. All right, questions on the risk-free rate? You really should sometime in your career graph the 10-year treasury. You can do it really fast. The only problem with this is that they have they put the holidays in there. So where's our 10-year? I think this is really tough. 10-year is right there. Some students do put the historical in their paper, and you certainly can. If you want to talk about the fact that the yield is just so low right now, you do have to get rid of the no data. And I don't know why the Fed puts that in there. So it takes me a second to get rid of that. Every holiday. So if you want to know every holiday in the last 60 years, there they are. So some dates in there too. So it doesn't take long to do a graph, right? You can do it in a few seconds. But from your own standpoint, you should know this history pretty well because this is pretty critical stuff. So we've been below 4 for forever, back to 2000, back to the financial crisis. So we haven't gotten above 4 quite some time, but before that, we spent almost all of our time above 4. And so, my career, the treasury below 4% was unusually low, just kind of strange, and we've been there now for 2 decades. So you have somewhat of a warped history. Your whole lifetime, there's a chance in your entire life the 10-year treasury never went above 10%, 4%, never above 10%, never above 4%. In my lifetime, it went above 15%. When I graduated from high school, there was the 10-year treasury, 15, 16%. So, will that ever happen again? That's the super high inflationary type of environment. So if you want to put a long-term history in there, that would certainly work. Right, the market risk premium. There are many approaches to this, and if you really want to see them, I've got a JP Morgan file I can send you. They go through all of the approaches. It's somewhat dated, and we had a student working for them that was going to get me the updated version, and then he quit, went to another job, so I lost my access. But here are the typical approaches. I'm going to recommend that you use the implied approach, mainly because it's the most common approach today. Dr. Ibbotson, for most of my career, used the historical approach. The historical approach, you just look at the actual return of stocks, the actual yield on treasuries, and you subtract. Real straightforward. And his argument is whatever spread stock investors got historically is what they expected, and so that's what they expect going forward. Some people think in the US, especially what we got historically was probably a really pleasant surprise. We did a whole lot better than what we were expecting. The VIX approach, if you use JP Morgan, they say the market risk premium equals 30% of the current VIX. So what's the current VIX right now? Where am I? Yahoo Finance. So the VIX is carat VIX. Current VIX, wow, it's come down dramatically, hasn't it? Wow, that's pretty amazing. 15.7, so go out and buy some call options and put options. 15.7, so 0.157 times 0.3. That would give you a current market risk premium of 4.71, which is a fairly reasonable number, maybe a little bit low, but it's a fairly reasonable number. It's a little bit low if you're going to add it to the 165, right? That would make it really low, but that's one approach. I don't remember exactly how they came up with this math, other than maybe they took the VIX and compared it to the historical approach just to see which would work. The corporate spread approach says, well, y'all know what a corporate spread is, right? That's how much more you're getting paid for the risk of corporate bonds going insolvent. So if spreads are wide, what should the market risk premium be? Should be high. So essentially it equates those two and gives you some kind of historical perspective in that. Corporate spreads are quite narrow today. I was looking at, I was kind of amazed at this. USA High Yield Bond Fund has a yield of 4.9%. Remember what I said the US Treasury used to be? 4 or 5, that 5-year Treasury, I bought it, I sorted at 5.16%. This is the high yield bond. This is below investment grade junk bonds, and it's yielding 4.9%. So yields really not, that used to be the normal spread for high yield. Now this is their total yield. I mean, this is everything, including the risk-free rate. So that argues for a low VIX. So we've got a little bit of a problem. And these approaches are giving you really, really low numbers, and you also have a very low 2-year treasury. So you can see Damodaran's argument of why your growth rate should be really, really low, because everything else is really low unless you're just going to dump a whole lot of money into the stock market. So we've got a little bit of a challenge. So I recommend the implied approach. I may have given you a document. I'll have to look and see if I put it out there. If not, I will give it to you. Let's see if I put this out there for you. Yeah, here it is. So my favorite article on the implied approach is this Barclay. Some of you have already read this before because I've used it in other classes. It's very, very, very dated, but the approach still works. There's nothing wrong with the approach. So essentially what they say is, these two guys, I don't know if they're around or not anymore. They're probably not Barclays anymore. You have seen these quotes before. Well, not those, but the quotes. Well, in here they say the market risk premium is the most important number in finance, the most important number in investing. So if anything, you should just be an absolute expert on the market risk premium because it is a really, really critical number. But here's the formula that they use. So RS, anybody guess what RS is? R is return, S is stocks. So the return on stocks should equal what? Income return. What is the income return? Used to just be dividend yield. Now it's dividend yield plus maybe an adjustment for stock buybacks. Nominal earnings growth. What is nominal earnings growth made up of? Inflation plus real earnings growth. And then repricing. What is repricing? Here's where I'm most disagree. I'm going to talk about this because I think this, I wish I could go to a presentation. I wish I could go to the presentation they made of this because I would have stepped out on a limb to see if I could destroy their final conclusion because I think they make a mistake here. But repricing is essentially, do you think the stock market is overvalued or undervalued? The stock market is overvalued, you can subtract for repricing because you think the stocks won't make as much. If you think market's underpriced, you add more. I think that's completely wrong. And I'll show y'all why at the very end. And then they break that out. So what are these two pieces? This is the income reports approach, income piece. So dividend over price, that's just a dividend yield. So which dividend yield does this represent? If you're doing Intel, you go get Intel's dividend yield. What do you use here? What number are we coming up with? Market risk premium. So which dividend yield do we use? The S&P 500, right? If you put the dividend yield of your stock, you're going to lose a lot of points, right? It has nothing whatsoever to do with your stock. If you mention your stock under the risk-free rate or under the market risk premium, you're going to lose a lot of points. It has nothing to do with your company, all right? Those two sections of your paper apply equally to all companies except for maybe the small cap and international. What do you think this is? That's the stock buyback. Why is it minus? Because if they increase their stocks, they're diluting the company. So they subtract that. But recently what's happened, firms have been buying more stock back. So that minus is a minus of a negative number. So you're actually adding numbers back. I'll give you that number. Why do you think these two numbers are? The I, inflation, and the G, real growth. All right. And then there, the change in PE. And it really is that simple. If you look at their number and they say historically the change in PE has added X percent, they just took today's PE divided by the PE ratio 50 years ago, took it to the 1/50th power minus 1, and that's what they say that number is. That's simple a number. And they go through each one of these pieces. Here's the historical numbers. 4.4%. What's the current S&P dividend yield? 1.3. Boy, that number has been coming down quite dramatically. So that number Used to be 4.4, today it's 1.3 plus what for stock buybacks? We'll have to talk about that, maybe 1.5. So maybe historically stock buybacks were less than stock issuances, and they somewhat netted out to zero. So that income return there is almost entirely a dividend yield. There was a theory in the 50s and the 60s that if the dividend yield on stocks was higher, was lower than the dividend yield, than the yield on treasuries, then the stock market was overpriced. And then that all changed in the 70s and 80s when dividend yields got really low and treasury yields got really high. Real earnings growth has been much slower in the U.S. economy. And that's going to be an important input, right? Inflation has been higher than what we were seeing here recently. And in the PE repricing, 1.5%. They add those together, and stocks are giving you a 10.7% return. Now, why do we get PE repricing? So there's two theories here. One is the stock market's overpriced, or it was underpriced when you started, one of those two, right? Or it could be both. It could be undervalued when you started and it's overvalued now. What else could it be? What would cause the stock market to appreciate up in value? It could be that risk is lower today than it was in the past. And I actually buy that argument. Commissions are much, think just the cost of investing. If it used to cost you 2% a year just to invest, that 2% is all extra return. So stocks can be more expensive because you can make a lower return before fees and you still have the same return after fees. So that can be part of it. I do think the stock market is less risky now. We have more information. Expenses are much lower. And just, the world itself is less risky today. So what does that mean? That doesn't mean that you expect a 1.5 repricing going forward. It just means that we don't have to correct for that. All that repricing is just rewarding those people for us going from a higher risk, higher cost environment to a lower risk, lower cost. Going forward, that should just be zero. So you can argue that, or some combination of the two. All right. And what they do in the rest of the paper is they just go through each one of these pieces and talk about them. And it's still a very fascinating, as dated this thing is, I don't know when it was written, 2002, so it's almost 20 years old. They do update this. Barclays does. I just don't have access to it because I'm not a Barclays client anymore. They do update it. But show you their final solution. So say this is their view. So income return, they have at 225. They added 75 basis points for stock buybacks. It's much higher today, so maybe you add a little bit more. They had a very low dividend yield at that time. So it was like 1.5% or even lower now. So you're probably going to get something in the 2 to 3% range for your income return. Expected earnings growth, you see they have that more than double what the historical number has been. Why do they say that? You have to kind of see what that argument is. So we're going to talk about this. This number needs to be tied to the U.S. economic growth, which is what? Anybody remember? If anyone remembers anything from my classes? So what are the two pieces of real economic growth? Productivity growth and labor growth, right? So productivity growth and labor growth. So productivity historically has been, 1.5%, 2% U.S. It's been much lower here recently. Labor growth is essentially zero right now. So, real economic growth, we're in that 1.5% to 3% range, unless you're just really optimistic. So that one's one we'll talk about. Inflation, the Fed's targeting 2. This is a number you can actually get using that forward curve. You can do the forward curve I did on the nominal treasuries. You can do the forward curve on the tips. You subtract them, and that gives you what the market thinks inflation is going to be. So you can do that number as well. If you watch my YouTube videos, it shows you exactly how to do that. So they add those together and they get 8.25%. And then what did they do? So let's talk this. This is a good time to talk this. They then say the stock market's overvalued, so we're going to subtract 75 basis points. And they say the expected return on stocks is 7.5%. I think that's absolutely bogus. right? So if you use a 7.5% as your discount rate instead of 8.25, right? They say 8.25 is what the market should give you, but we think the market's overpriced. If you use a 7.50 instead of 8.25, what's that going to do to your valuations? It's going to give you a higher valuation, lower valuation. If you use a lower discount rate, the valuations will be higher. Okay, so they're saying use this rate and it's going to increase your valuations, or you use this rate and it reduce your valuations. What are they telling you about the stock market? They think it's overvalued. You want to artificially reduce your discount rate so you get higher valuations of stocks to encourage you to get in the stock market when you think the stock market is overvalued. Does that make any logical sense? What should you do? Use 8.25, and you're going to find a lot of stocks are overvalued. Does that seem consistent with your philosophy that the stock market is overvalued? Right? I don't know why they made this adjustment. Don't you wish I could be there to ask this question? Y'all could watch and laugh at me when they just tear me down. But why in the world would you make this adjustment? You think the stock market's overpriced? Use the higher discount rate. It means there's going to be far fewer stocks that you're going to buy because the stock market's overvalued. So I don't understand that adjustment at all.
Can't have an overvalued market without overvalued stocks.
Right, but they want to fix that, so they encourage you to buy a bunch of overvalued stocks. That doesn't make sense to me. So just a little bit. Now, what they're saying is this is what we expect the stock market to make. But essentially, I think they're saying this is what they think the average stockholder needs, but the stock market's not priced to give them that. The stock market's priced to give them 750. So essentially what they're saying is, this is what you need to cover for your risk, which is what a discount rate is, right? But this is what you're going to get. So they're essentially saying, avoid the stock market, only buy those stocks that are really cheap right now, which is not going to be many. So I think this is an error in their paper. But who knows? When they first presented this paper, they're really excited about it, but someone else presented right after them and no one cared about their paper and they're all upset. When I saw this paper, two presenters after them was a guy named Jack Bogle. If they've ever heard of Jack Bogle, the only time I've ever met Jack Bogle, and boy, is he an intimidating person. When you're wealthy and smart and you don't care, you say whatever you want to say, and boy, he just, whoever came right before him, he went up there and just destroyed their entire presentation. He didn't care one bit that he was destroying their entire presentation. It was quite, those poor two guys that presented. It wasn't this one, they presented before him. But yeah, but I didn't ask any questions. I was too chicken back then, but I wasn't thinking this. It was taking me a while to let it sink in. But all right, so essentially what you're going to do in this paper is come up with, I'm saying these three assumptions. I'm going to say completely ignore the repricing. I don't think that's important. So the income return, I'm going to give you a paper to help you with the stock buyback argument. Earnings growth, we're going to tie that to the economy. So I'll show that. Some of you have me before and have seen how we do that. And inflation, you can use the target from the Fed, or you can use the forward curve and come up with it. So we'll go through those pieces. All right. So really, this part of the paper is make a decision on the 10-year treasury, and then use the implied approach. And I'm going to walk you through the different pieces on the implied approach. Okay. And then beta, some of you have had me before on beta. So I'll walk you through that 4-step process. I think you should do that process. This is the thing, some of y'all heard this story before, but I've been using this 4-step process. I had a gentleman speak to this class. He's one of our portfolio managers, really good investor. He was probably in his mid to late 70s. I don't know if he's still alive today. Probably not. That was like 20 years ago. Really fascinating guy, really, really smart. And he said, I want to speak to your class. And I said, yeah, that's great. He says, and I'm probably going to disagree with everything you've taught them. And so that's fine. He came in and he just destroyed beta. He said he hated beta. And the reason he hated beta, he put up a chart of Merck's beta over time and showed it going like this. And he says, there's no way Merck's business is changing like that. That they're the defensive company, now they're a cyclical company, now they're defensive. There's something wrong with beta. So once I saw that, I stopped doing what all your other classes show you how to do, which is the regression beta. And I've changed to this 4-step process. And then after I did that for a few years, I saw Dan Madarian using the exact same process. And I know he didn't get it from me, but so it makes me feel good. Dan Madarian's process is word for word the same. I know my students think I stole it from him, but I didn't see his process first. So it's just, sometimes a non-genius and a genius will come up with the same thing just by pure random chance. And then what you're going to do, and this is very, very important, is I want you to have scenarios. All right. So I do not believe a stock has a value, even though I know the sell side does that. They have a target price. I don't believe in target prices. I believe in target ranges, a distribution of values. So at a minimum, I want you to have a base, a best, and a worst case. And I'm actually going to encourage you to do a data table, like you took my investment class, have a data table, or you can have a distribution. Or what's even more popular today is the football field. Have y'all seen that? That's become the rage. And I haven't actually, maybe, Vaughn, maybe you can teach us how to do this in your class. But have y'all seen this before? That look familiar? So I'd encourage you to get the football field into your paper just because it's becoming so popular. I think the Coca-Cola one has a football field in his. It looks, it's a little tough to build this in an Excel graph. I can guess how to do it. You might even go on Excel and just type the word football and see if it comes up. Excel might already have a football field already built for you. But essentially what you're doing is, you can see this first one. They have the 52-week range, current analyst forecast, and then different valuation models you had in their ranges. And what you're trying to do is, like this stock looks pretty good, doesn't it? There's this 52 range, this is what analysts are saying, but you've got valuations that, your worst case, this is what we talk about, a margin of safety. You look at your worst case, here's the current stock price. So it looks like there's a little bit more positive here. I don't know, it's kind of balanced here. But what you're trying to do is figure out, does this stock have more upside or more downside? All right. So how many of y'all have done a football chart before? Anybody in here? But y'all have seen them before, so they are coming around. So it's one thing you want to get into your paper is whatever the current trend is, get it in there so you're with the current. Well, I mean, maybe it'd be out of date by the time you finish your paper, but it'll probably still be around. So we are going to run scenarios. We're going to run scenarios on beta and on growth. Those are the two things you're going to vary. All right, so I showed you how you can get historical treasury rates. All right, so let's talk market risk premium. The miscellaneous materials. Where did I put it? Oh, God. All right, I might have forgot to put it in your class, but I know I have it in another class. Let me find it in another class. Oh no, where did I put it? Oh. I think I put it in there, but I just forgot where I put it. Here we go. All right. It's on our site somewhere, but I don't know where. So somewhere on Blackboard you have this. But. All right. So we're going to start off with this theory that a stock return, an expected stock return, is its income yield plus earnings growth. All right. Some of y'all have seen this chart before. I used that for years and years and years, and then it kind of dawned on me. It's like, well, is that actually true? So I decided to build the chart to see if it's actually true. And so I went back to 1871. Anytime you see 1871, whom do you think of? Robert Shiller, right? Robert Shiller's data is out there for free in an Excel spreadsheet. He's a now, Nobel Prize winning economist. So I used his data. I don't know where he got the S&P 500 in 1871, but somehow he came up with it. I don't even know what stocks would be in the S&P 500 back then. That's coming right out of the Civil War. And So I took the actual S&P 500 using his data up until the time I actually got the actual numbers, and then I put the actual S&P in there, which he did as well. So here's the S&P 500, and then the red is each decade's dividend yield plus earnings growth. Just added together and linked, okay? And I think it's a fairly impressive chart. It really does track pretty well. When the market gets above it, it comes back down. When it gets below it, it comes back up. There's your 2008 adjustment. So as I always say, that was for 15 minutes, Robert Shiller said the stock market's not overpriced. Because that was the first time in many, many years that his model actually showed the stock market not overpriced. And then since then, we've been up there. You can't even see COVID, can you? Doesn't really even show up at all. I don't know where I went. I think I did everything through August. You can definitely see COVID in the earnings growth. So 2020 was the last year of the last decade, and 2021 is this decade. So I brought in enough earnings to get me back up. So what he noticed here is the stock market has been well above this line, but again, why could that be? So again, two reasons. The stock market, your discount rate could be lower because of lower risk, or interest rates are lower, or the market's overpriced. And I think it's probably a combination of the two. The other thing it could be is the stock buybacks. I actually put an assumption for stock buybacks in here, so that includes it. And it did not have that big of an impact in the red line. So it's in the red line, so it didn't have that much impact. So we're well above that line, but for most of the time, they track pretty well.
How much would the stock market have to lose to get back to the red?
Oh, it's like 40–50%. Yeah, it's a lot. I mean, this is a log normal chart. So there's a big difference between that line and that line. Huge difference. It could be 50%. Yeah, it's a huge difference. But at the same time, if the discount rate's 1% lower, that's a huge difference too. That shoots the thing up. So what that means is, if this is a risk thing, what it means is not that stock market's overpriced, but what it does mean is from this point going forward, the blue and the red lines should be parallel. So you have this one-time adjustment for risk, and then you just go parallel from that. So it doesn't mean this chart's incorrect. It just means we've had some adjustments, and then going forward, we should go parallel to each other. All right. So I think there's some credence to this being stocks. We also have the PE repricing, which is what this is. The PE repricing could just be a risk adjustment or an expense adjustment. You know, there's other things going on. Then you have to come up with your growth rate. This is more paper 5, but you also need it in paper 4 because you have to come up with the market risk premium. So I graphed the U.S. economy. Boy, I hate this stuff. I really do. So here's economic growth in the U.S. Here you can see COVID. That's a pretty big drop. Pretty amazing drop. So nominal GDP growth in the U.S. through, I don't know why that says 2022 because I don't have 2022 numbers, but anyway, our economy grew 6.32%. This is nominal. You want nominal. Corporate earnings growth has been 5.76. You can definitely see 2008. 2008, why in the world did 2008 do this? Do all to one sector. What one sector drove this whole thing? Can you remember? Which ones? Financials, I think I heard. Why did financials do that? They didn't actually lose that much money. So what happened with finance? What did the accountants do to us? Fair value accounting. That thing we were talking about, FAS 117, whether it was. Fair value accounting. They marked, I remember at USAA, they had to write down, we had this high quality investment grade bond portfolio. You had to write down 20%. You had a $2 billion write down. When you're running a portfolio and you have to write down your earnings $2 billion, you get some interesting phone calls. How did he do in 2009? He wrote it all right back up. Right, wrote down 2 billion, wrote it right back up 2 billion. So this was fair value accounting. if you could take that, these previous years didn't have fair value accounting, so it's hard to really compare the years. This is not fair value accounting. This is Carnival Cruise Line and Delta Airlines and restaurants and those kind of things. So, but we're back to the long-term line. The long-term line, according to Darren, is the 10-year treasury. You can see he's pretty good, right? He says you should use the 10-year treasury to forecast your earnings growth. Can you get much closer than that? I mean, maybe it's off a few pennies, but that's incredibly close. But are you really going to use a 1.65% growth rate going forward? That's kind of scary. And then I did a 5% growth. And you can see that somewhat gives you the bottom. So the actual economic growth on the top, the 10-year treasury matches corporate earnings pretty close. So what I'm going to argue is let's use economic growth as our growth for earnings. And it's going to be maybe a little bit aggressive. Why aren't they the same? Well, they're not the same mainly because this red line is not the stock market. It's only the S&P 500. There's a lot more stocks besides the S&P 500, and they tend to grow much faster because it's smaller companies. So we're missing that pretty important piece. Plus, it doesn't include private firms, venture capital, startups, those kind of things. So there's enough other growth in there. You would expect corporate earnings and economy to grow the exact same speed. There's no reason to be different. So we can. I think we're okay with the argument that they should not be in line. So what question does that raise then? We're going to tie our corporate earnings growth to GDP growth, and what do? You already know what the chart coming next is. Where does economic growth come from? All right. So you can put these charts into your paper. This is the chart most students put into their paper. I love this chart. I updated it through. I had a big debate here. What do I do with the COVID quarter? So I kind of ignored it. You know, Sergio's class on Bloomberg Market Concepts, they have these wonderful charts you can look at, and the video only goes up to like 2017 or 16. So I said, wow, those really cool charts. So I did the most current charts. You can't even see the charts anymore because COVID just completely takes over the chart. So that was a pretty big event. So here's the components of economic growth, productivity and labor, and you can see the historical numbers. And so this is why I argue productivity about 2% makes sense. We've had really horrible productivity this last decade, pretty strong before that. Some people don't believe this number. How can we have that kind of productivity with the internet and robotics? And that's really, really hard to explain. My argument for why it looks so bad is because the two huge parts of our economy, education and healthcare, are incredibly unproductive. And the most productive parts of our economy are getting smaller and smaller and smaller. Like manufacturing is incredibly productive. I wish I had the numbers, but you should look at numbers on how much steel is produced today versus how many people are producing steel versus back in the 70s, how much steel was produced versus how many people. There's just massive. The steel per human is just massive what we're doing these days. So I think we have somewhat of a barbell. A big part of the economy is becoming really productive, but we don't notice that because productivity is related to labor, and those parts of the economy are doing a lot without much labor. And then the economies that are heavy labor are very unproductive. So, you know, how do you handle that? You just have to kind of look at the history. But so I tend to say, okay, productivity about 2%. Obviously, labor growth is not going to be 1.5%. It might be 0%, but maybe you throw 0.5% in there. We are going to have some workers in the United States. With baby boomers retiring, someone's going to have to take care of all those people. And then inflation. So you can definitely put this into your papers. So you can also put your own forecast or someone else's forecast. What you can't do is get GDP growth the last 2 years or last 3 years and use that. That's too short term. We're talking the next 50 years, not the next 2 years, all right? So don't go out and find a forecast for 2022 and use that as your answer, because that's not gonna work. You're gonna get something like 4% real growth because we're still coming out of COVID. That's way too fast growth for the United States. You're gonna be somewhere in that 2 to 3.5% range. But you can use someone's long-term forecast if you can find a good long-term forecast. As I said, you can find long-term forecasts for inflation. You can just use the bond market to do that for you. But labor growth, I think, here's my argument is, if productivity is well above 2%, labor is going to be well below that, 0 or lower, because we're just going to be replacing labor with productivity. And I do think, I was talking to Devin about this earlier, I do think healthcare is set up to be disruptive, and I hope it is disruptive. I hope the number of people working in healthcare 20 years from now, well, except for Devin, 20 years from now is like 1/3 as many as today. Not that I want to go see a robot doctor, but I sure don't mind, putting my finger on some smartphone and it tells me everything about me. It's like, you're going to die in 18 years and 3 months. So I hope we get to that point. But I mean, that's the key to productivity, is we got to take those most heavy employment industries, and they've got to become more productive. And right now they're not. They're going the wrong direction. All right. So what we'll do next class is I'm actually going to walk you through all of these numbers and an example of how I would do Walmart. Walmart, how I do theirs. So I'm going to essentially write paper 4 for Walmart in our next class, so you can see me go through the whole process. I'll probably cover beta first. Those that have me before on beta, you'll just have to sit through that again. But we'll do my beta approach. All right, I'll let you out a little bit early here. All right, let's start. All right, so tonight I want to make really good progress on paper, whatever it is, 5, I think it is. I'm getting so confused. Make really good progress. What I want to do, sometimes I like to step out of notes and just summarize exactly what you're doing, because the notes, I think, get a little busy. So paper 6, paper 5, whatever it is, 3, 4, 5, you're trying to get a KE for your firm. All right, so we got a little bit of a debate here with the other professors. They want me to do the traditional free cash flow approach. The traditional free cash flow approach needs what? Not KE, but what? WACC. And I really don't want to do WACC in this class, because this is not a corporate finance class where you do WACC. So I'm actually trying to avoid doing what they actually forced it into the course description. Like, please no. Because I just don't want to handle the whole WACC, cost of debt and subtracting debt and market value, book value of debt, all of that kind of stuff. So I'm going to talk through it, but I'm not going to require it as one of the calculations. We are going to do the traditional investment banking approach, but we're going to use KE instead of WACC. If you want to calculate WACC, you can, but it's a lot of extra workload. What I don't like about the traditional approach, or that the most common approach, it gives you really wacky answers. So there's some issue with, I had students try and say, well,
I'm ready, thank you.
Really strange answers. So I don't know if who's unmuted. Make sure you're muted. All right, let me share again. All right, so you need KE. To get KE, it's real simple, because we're going to use CAPM. So you only need three numbers. And your risk-free rate plus beta times the market risk premium. So paper 5 is a 3-number calculation. We talked to risk-free last time. I gave you a few approaches. One is use the actual and then explain the low rate. And you can use Damo Darren to help you with that. If someone finds a more current Damo Darren, send it along to me. I should go out and research that. I'm sure he's written about it again. See, Bill Gates doesn't know him, but that is his name. It might be AN at the end, Damo Darren. Oh, he does know Damo Darren. All right, you can use the forward curve. I like the forward curve, especially right now because of COVID and other things. Eventually, I might throw in the towel and go with Damo Darren's approach, just because rates have been low for so long. You notice the 10-year is starting to creep back up there again, but boy, 2% is just it's having a tough time getting back above 2%. And then the one I don't like is normalize. I see it a lot because a lot of students just go and look in previous students' papers and just.
All right. Yeah, I didn't want to fucking be in there hearing all that bullshit.
I hope he wasn't talking about my class, but. All right. Yeah, make sure y'all are on mute. He's still not on mute. Yeah, or is he on mute? I don't know how, but it says to ask to unmute. Did I? Yeah. Oh, there it is. I didn't see. Okay, sorry. Yeah, the struggles of All right. So if you normalize, the problem with normalizing is that it's hard to say, you know, we're at this abnormal period of time for the last 15 years. It's hard to say 15 years. If this were a couple of years in after a major crisis, yeah, then you can say normalize, but what is normalized? So I'm not a big fan of normalizing, but whether you use the forward curve or the current, you have to explain. So there's a little discussion. So it takes a little bit. So I'm gonna take this one out because I don't want you to do it. But if you do it, I'll count it. You probably won't get as many points. I think normalizing has just lost any credibility just because of the length of time we've been at very, very low rates. There is a lot of theoretical problems of a Federal Reserve targeting 2% and then the 10-year at 1.65%. There's a lot of problems with that combination. Why would anyone lock in a rate that's below expected inflation? And now people are talking about inflation a lot. 5-6% inflation is what has the 10-year Treasury done? It's gone up 10 basis points. So it's a very theoretical and tough number to talk about. All right, then you have the market risk premium. The recommendation I have is that you use the implied approach, just because the implied approach is the most common approach. All right, the implied approach says the required return should equal the expected return on stocks if markets are efficient. So it's just a real basic assumption. With the implied approach, or with the market risk premium, what are we trying to do? We're trying to get the required extra return for holding stocks, right? That's what we're after. But we can't get that number anywhere. You can't go look up what people require over bonds to hold stocks. But there's the assumption that, well, if stocks are priced to make 8%, then that must be what investors need is 8%. If they needed 9%, what would happen? The stock market would crash until the expected return on stocks was 9%. So it's a theoretically pretty good argument. And so there what we say is the expected return on stocks. Anybody remember this formula? Pretty easy formula. Dividend yield plus expected earnings growth. So that's pretty straightforward. And then the article I showed you, they add in the repricing. I argue you shouldn't add in the repricing. And then expected earnings growth. I argue that should be a very tight function to expected economic growth. So, you can follow my template exactly here, or you can come up with your own thing. You come with your own thing, you better, check with me in advance, just in case you're going off on a tangent. Examples of what students have done in the past is look at economic growth the last 3 years, or something like that. Yeah, nominal. Everything's with inflation because this is nominal. The article broke up nominal earnings growth between inflation and real growth, but you need inflation in there. And then expected economic growth equal productivity growth plus labor growth plus inflation, all expected numbers. Right, and I gave you a chart to help you do that, right? You can use my chart. Again, don't go back 1 or 2 years. We're talking over the next 50 years. So if you're gonna use any kind of historical data, we're talking going forward. History just gives you a sense of where we've been in the past. But that's why I gave you the chart by decade so that you could see. Hopefully I remember to put that on Blackboard. If not, I'll try to remember to put it out there. All right. And so once you have that, then you have your expected return on stocks, and you take your market risk premium. It's going to be expected return on stocks minus the risk-free rate. You got your number. All right. So how much more do you need on stocks above the risk-free rate to induce you to hold stocks in general, not your particular company? So don't give me if you give me your company's dividend yield, you lose a lot of points here. Right? The market risk premium is the entire market. What is the dividend yield of the market? What is the expected earnings growth of the market, not of your company? Okay, that's real important. And then once you get that, you get a market risk premium. Now, there's one major theoretical problem with this whole thing is whose required return are we talking about? The average investor. Do you care about the average investor? I mean, what number do you actually need? You need your required return. Why do we have to go out there and theoretically figure out your required return? Why are we assuming that you're the average investor? So how do you come up with your required return for you personally? And your theory is as good as anybody else's. You say, well, this approach gives me a 6% risk premium, but I think I'm more risk averse than the average investor, so I'm going to add another 2%. I don't know what, there's no theory there. But I've never seen any textbook that talks about how we personally come up with our own required return. It's always what this average is. So, if you're higher or lower than average, if you're managing a mutual fund that has 500,000 customers, then probably the average investor is a good approach to use for that. Who knows? But it's very, very, very theoretical. But you need some basis for coming up with it. And so I like the implied approach. If you want to try some of the other approaches, that's fine, just to get some practice. But have some basis. But as I mentioned last class, in the last 30 years, we flipped from the historical approach to the implied approach, and it just kind of gradually happened over time. I switched when I read the Barclays article. So we started immediately as USA going the other way. But for the longest time, we're using the historical approach. And if you really want to get into this, there's one person who does this more than anybody else, and that's Roger Ibbotson. He's going to have plenty of articles, books. I remember reading one article where Dr. Ibbotson wanted to do a survey of all the history of this. And it's like sentence after sentence. According to Ibbotson, blah, 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 and blah, this. But according to Ibbotson, blah, 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 it was this. However, 5 years later, Ibbotson, blah, 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 he was quoting himself constantly in this article. And it's like he's in every single study. And I remember one time, he got in a debate with this guy named Brian Rahm, and it's not the kind of debate you want, but they were writing editorials to Financial Analyst Journal, and they're debating each other every issue. So one would write, and the next one would write, and poor Brian Rahm just got really beat up by Roger Ibbotson. So I called Brian Rahm and talked to him. I was kind of curious what he was up to. So I encourage y'all to do that, right? You see something going up, just call the person. Say, hey, I saw you in this article. I'm just kind of curious what you're up to. The guy was so stressed. I don't think he wanted that kind of publicity. Poor guy. But he wrote the letters, right? No one forced him to write. But interesting. I don't know what he's doing today. I'm sure he's probably still out there, right? And from, yeah, maybe he's probably gone now. He's probably couldn't take it anymore. Probably he's completely different career. All right, so that's the market risk premium. So that one's a theoretical discussion. So those pieces you can do just off the top of your head with, get some data from some of the charts I've made for you. And then the beta. So here's where you get company specific. So you do have what's called a regression beta, but there's a problem with that. And that regression betas are very, very unstable. Far more unstable than theory allows. So that's a huge problem with the market, with the capital asset pricing model. Beta supposedly measuring systematic risk of a stock. We covered that probably in 3 or 4 classes already. Kind of really getting tired of hearing the beta definition. So in this class, we're just going to apply that. But all those theories, they somewhat imply that a firm's beta should be pretty constant because they're not radically changing their mix of systematic and unsystematic risk. Or are not changing their systematic risk's nature, that becoming a cyclical stock and a defensive stock. But we'll see. I'm going to do Walmart today, and you're going to see Walmart has been radically all over the place. So what are we going to do? Well, beta is what? Is a forecast. Beta is not what? I don't know. This is my favorite quotes. Got a T-shirt that says this. Beta is not what? Right. Beta is not a number you can look at. Why not? Because Yahoo Finance is what? It's a regression beta using monthly data for the last 5 years. So it's just one point in time. Has anything unusual happened the last year that might distort beta calculations? Maybe so, right? So you can't just look up your beta in Yahoo Finance, although I think probably 90% of finance students do. You can't. I joked on Facebook. I visited Columbia University. I said, "Yeah, I found some finance majors and told them to make sure to get their beta out of Yahoo Finance so we could destroy the competition here." But we're not going to do regression. So it's a forecast. So how do you forecast it? And so I'm going to require you to do this 4-step process. So I'm required to use my approach. Remember, this is also Damodaran's approach, so you've got some better support than just me. So anybody remember the 4 steps? Y'all have had me before, some of y'all. What's the first thing? Yeah, the revenue nature. Is this a cyclical defensive product? Right, start with the company itself. What does it sell? Is it selling a cyclical item or is it selling a non-cyclical item? So start with that. What's the nature of their revenues? So cyclical stocks sell expensive items, discretionary items, heavy machinery, things that are closely tied to the economy like steel and concrete and those kind of things. Defensive items are those that are staples. They're bought no matter what the economy is doing, just from the nature. It sounds like defensive. They tend to do well. They're non-cyclical, so they tend to do well even in recessions. The way I think about it is a simple question. If a recession hits next year, let me give you the wrong question first. Will their revenues fall? Why is that the wrong question? What if we have a horrible recession next year? Is every company whose revenues fall a cyclical company? So what's the real question? Will their revenues fall more than the average company, right? Beta is a relative thing. So it's a relative thing. So you don't just say, hey, we have a recession, our revenue is going to get hurt. Well, yeah, almost every company out there, we have a recession. Walmart, maybe, Walmart actually did really well in 2008 and did really well in 2020. But Walmart's not like hoping for a recession that suddenly a million people are going to show up. Maybe people stop going to Nordstrom's and go to Walmart, but there's going to be people who aren't going to Walmart because they were hurt by the recession. So it's a relative thing. Is this firm more hurt by recession or less hurt by recession? And you start with the revenues. That's the key, all right? So is your firm defensive or is it cyclical? You can certainly do some Google searches and other things that kind of get a sense of how people classify your stock. There's some industries that are pretty obvious. If you're a consumer discretionary, then you are a cyclical company. If you're a consumer staple, then obviously you're a defensive company. Some are pretty straightforward. Some others are getting tricky. People are really confused about Facebook and Google and some of these, and even Apple, some of these companies that almost feel like they're becoming utilities. So that's the first question. The next two questions relate to leverage. So what we're asking is, all right, we talked about the revenue. Is there something in the income statement that makes this company even more volatile? We're talking about fixed costs. And what are the two fixed costs we're looking for? Well, the first one is operating leverage. And the second one is financial leverage. So leverage makes a firm more volatile. It won't flip a defensive company into cyclical or a cyclical into defensive. What it does is leverage will make a cyclical company more cyclical. It'll make a defensive company less defensive. Okay, so think of it in those terms. So it's rare that you're going to take a 0.6 beta and make it a 1.4 beta. But you could take a 1.4 and make it a 2. You could take a 0.6 and make it a 0.8. Like Kroger's right now, I haven't looked in a while, but Kroger's has recently had some really ridiculous debt levels. Now, Kroger, what is Kroger? Defensive or cyclical? Definitely defensive. If we look at their debt, where is the debt? They keep moving this stuff around. Total debt is 21 billion. Their debt to equity. Let me know if this is below what I just did. Oh, debt to equity. 229%. That's a really high debt to equity. Right? For every $1 in equity, they have $2.30 in debt. That's really, really high. What does that do to their beta? Does it push it up to 1.7? No, but it might push it up to 0.6, 0.7. So, those are the kind of things you have to adjust for. I'm going to show you a spreadsheet that's going to help you with that. What does Yahoo Finance say their beta is? 0.44. I don't believe that number at all. That's way too low. I wouldn't push, to me, grocery stores are 0.5, 0.6, and then with all that debt, I may push them to 0.7, 0.4 is just way too low. But why is it 0.4? Because we just went through COVID-19, right? Kroger's probably did okay through the whole lockdown. I mean, when's the last time you stood in line for an hour to go grocery shopping? I did that at HEB. It's pretty unusual, right? Right, so that's operating leverage. That's the degree of fixed cost and cost structure. So here, think about it theoretically. I'm going to give you some numbers that help, but think about it theoretically. So what are the kind of things you're looking for? So if you have a lot of depreciation, you have a heavy property, plant, and equipment, there's a fixed cost you have that's the same no matter what. And you might say, well, that's not economic, but it still is going to make your earnings more volatile, your reported earnings more volatile, and that probably has some psychological effect on markets. If you have salaried and unionized employees, that's probably going to increase your fixed costs. If you're a pharmaceutical, you've got heavy, expensive scientists working for you. Last thing you want to do is let them go.
Would R&D also be?
Yeah, R&D is a good one. R&D and marketing. Those expenses that you just have to do because it's core to your business. So Nike, I might think of Nike as, boy, they've got to spend money on marketing. Now, Nike's marketing is a pretty constant percentage of their revenue. It makes it almost look like a variable cost. In that case, that might cancel it out. But you look at these pieces, it's kind of tough. One thing I don't like about the GAAP financials is they don't give us much detail on the expenses. I wish we had a whole lot more detail on the expenses that we could look and see exactly where they're spending their money. So you can kind of go through and just see, but think through what they do you know, versus hourly workers. You would think hourly workers, if you have a slowdown, you could easily lay them off, cut back their hours, those type of things, and that certainly would help you reduce some of that volatility. So just think about your firm. There's no way to really truly measure this, although I'm going to give you one way to measure this in one spreadsheet. And in financial leverage is the easiest. It's just your debt levels. Here I use debt to equity because it's the most common approach, but any measure. And there you're just looking versus the market. Now here's where you get to add a little bit more. I'll give you a few extra points. Very few students do this, but I just showed you Kroger's, and I showed you why that's really high debt to equity. But maybe the whole industry is doing that. So maybe I should bring in some of their competitors and just see, are they really out of line? You've already done that though, haven't you? Where did you already do that? Paper 3, didn't you? Didn't your paper 3 compare your company to its industry? So you already have that information. So you could use that again if you'd like and bring it into this paper. And you could even bring that chart in again or reference back to it. There, I didn't use debt to equity. I used debt to EBITDA, but you could still use that to show if your firm's extremely high, extremely low on the debt. There are other things I've forgotten. There's like leases. Boy, I can't think about it, but there's some in the notes you can see. All right, so that's what you're gonna take the top line and ask how sensitive that is to the economy. Then ask about their leverage, debt, and operating structure. I would guess most of your firms, their operating leverage would be similar to their competitors. Financial leverage can be anywhere, just depends on the company. And then the last thing you're going to do is look at the history or perspective. Right, here's where you can lose a lot of points on this paper. Students write about revenue, they write about operating leverage, financial leverage. They show history, and then their entire answer is on the history. It's like the other 3 things were a complete waste of time. Why did they even do it? All right, you can't do that. Right? So how can I encourage you not to do that? Again, just like I talked about with the porters, maybe you do a summary table on each one of these. So revenue, definitely low beta, somewhere in the 0.5 to 0.7 range. Operating leverage, still pretty low, very low volatility of EBITDA. Financial leverage, that's going to push me back up. Their debt is really, really high, one of the highest in their industry. History suggests between this and this, therefore my final answer is this. Okay, you'll see how that works. That way that forces you to acknowledge all those kind of things. I can always tell students they're kind of going through the motion versus actually doing the analysis and letting the analysis actually influence their final decision. Okay, so that's it for beta. Questions on that process? I'm going to walk through it with Walmart, so we're going to see it. It's 1, 2, 3, 4. All right. So you have 2 leverages there, but it's all part of leverage, all right? So the leverage part is you got your revenues. What does revenue have to go through to get to the bottom line? How much of that is fixed and is going to cause volatility? And then you have your final recommendation, which remember is going to be a base, best, worst. What's higher, best or worst for a beta? Worst. Your worst is going to be the highest, your best is going to be the lowest, because you're talking about discount rate. So the best case is going to be the highest stock price, so it's going to be the lowest beta. Be careful in your best case, all right? Always remember this. KE must be greater than your long-term growth, all right? Always remember that. So be careful you don't get a beta so low that your discount rate is going to be 3% and your long-term growth is going to be 4%. That's not going to work, all right? So be careful on that. All right, so there's your entire paper, whatever, 5. right, so I want to actually do this for Walmart. The long-term growth for your company will be what we call terminal growth. For most companies, it's going to be real close to long-term growth, economic growth you use in paper 5. For most people, it's the exact same number. It could be slightly different. You might say, you know, this is, you know, you're doing Valero. The economy is going to grow 5%, but, you know, Valero, my word, no one's going to be driving gas cars in 10 years. So I'm going to cut them down to 2% or something. So you can adjust it. But for most companies, for Walmart, I'm going to use something slightly below that. Just because, you know, I don't think they have, it's going to be such a competitive industry. I don't think they can do actually equal the economic growth of the economy. All right, so risk-free rate. I'm going to have a discussion is, I think rates are unusually low and should adjust back to more reasonable levels. I'm avoiding the word normal as much as possible, but you need some discussion about that. It's interesting, the first time I taught this class years ago, the risk-free rate, you went and got the 10-year treasury, no discussion, you just went and got it. Market risk premium using the historical approach, you just went and got the number. Beta, you just went to Yahoo Finance, if we had Yahoo Finance, I don't know. We had electricity, but I don't remember we had the internet. Go to Yahoo Finance, you get the number, and you're done. So their paper 5 was like 2 sentences. A lot easier. All 3 numbers, you just go get them, and that's what we did in practice. I mean, it was pretty straightforward. Here we are several years later, and of those 3 numbers, 3 of them are really insanely ridiculous right now. We have no clue what to do with all 3 of those numbers. So we're in this incredibly unusual period of time. So I'm going to use the forward rate. You don't have to use the forward rate. I'm going to use the forward rate to say, let's get past clouds of COVID, something like that. I'm going to make some kind of argument like that. Yes, I realize the 10-year treasury has been low for quite some time. However, coming out of 2019, the treasury rates are getting up there pretty high. I might even show that we're starting to get back to at least 2.5%, 3% treasuries, and COVID destroyed all of that. I think we're going to get back again after this is over. So I don't want to use the current 10-year treasury, so I want to use the forward rate. All right, and so I'll use the forward rate. I don't know what those are, but let's say the 15-year is 1.8%. Let's say the 5-year is, I have no idea, my word, I never think about the 5-year anymore. We're frying wrong. It's the 5-year. 123, wow, that's been coming up pretty strongly as well. Did my 1.8 look reasonable? Seems pretty reasonable, right? I'm in between those 2. So I could go get, you remember how I could actually get the actual rate? You go find somewhere out there, I need to find that link and give it to you. Just get every single treasury, and you find the closest to 15 years. All right, so here's the forward rate. I messed this up last class and I don't know why, but let's try this again. 1 plus 1.8 raised to 15. That's right. Any problems with that? Divide that by 1 plus 1, 2, 3 raised to the 5th. The issues there. Take this entire thing and raise it to what? Divided by 15 minus 5. Is that right? Minus 1. That's my other class. Would you bet $1,000 I did it right? How much confidence do you have in your? Does that look reasonable? It has to be higher than 1. It has to be higher than 1.8. Right? Because if you're going to invest 123 for 5 years and then something else for 10 years, to get 1.8 8, then it must be much higher. So 209 is going to be my risk-free rate. Boy, that still seems awfully low, but at least it's above inflation. At least I'm getting something there, all right? So there's my argument. And the other thing is, they're talking about the 10-year being a risk-free rate. Is the 10-year a risk-free rate if you're expecting rates to rise? You lose money, right? The 10 years goes down. How's the only way you don't lose money on a 10-year treasury if rates go up? Well, if you have a liability that pays out exactly the cash flows of the 10-year treasury, in that case, you don't care. But who has that, right? Who has a liability that's $30, $30, $30, $30, and then suddenly $1,030 in 10 years? That's just unusual, right? So is the 10-year really risk-free? It's not risk-free. You have risk because you can't perfectly line that up. Okay, so how long does this take? Some students do it in a couple of paragraphs, some take an entire page. I could certainly bring in a graph of the 10-year treasury and show that more recently, if I'm trying to make the point that the 10-year is getting back to more normal levels. I'm trying to avoid normal, the word normal, more reasonable levels. But COVID disrupted that. Now I think we can get back, however you want to argue it, the pictures do that. This is not a 6-page exercise right here. You can easily get it done in a half to a page. All right, questions on the risk-free rate? So most students do okay with that. I have had students say, I think the forward rate is the best way, therefore I will use forward rate. Because I told them, tell me why you're using forward rate. That's just not enough information for me. All right. Why do you think the forward rate's the best approach? I gave you my answer, right? We're in this cloudiness and code, whatever, creative writing. So you need to do better than that. I get the same thing on paper 6. I think it will take 10 years to get from the short-term growth to long-term rate. Therefore, my H is 5. And that's their justification for the H, but that's not a justification. That's, so explain to me where you got the 10 years from. Explain to me why you think the forward rate's the right approach. So in this paper, you need to have some justification on your approach. You can quote Yamadaran, you can quote, you can reword what I just said if you like my approach, however it goes. Okay, then the market risk premium. I use the implied approach. Expect stocks to return dividend yield plus stock buybacks plus expected earnings growth. It's kind of hard to read. What button can I push to wrap text? Do they know? Yeah, but I mean, what button can I push? I don't want to have to use the mouse. Oh, it's up here?
Yeah, right there.
Ah, thank you. All right. Where did that come from? Yeah, but I don't see a key for that one, so I'm not real sure. Okay. Yeah, I want to do it with buttons. I don't want to grab my mouse, but okay.
And then
I still have to go up and choose it.
no, we were like Alt H, like do it.
Alt H.
No, Alt H. And then W. Yeah.
Okay. All right. So okay. I'll practice it. All right. So I'm using the implied approach. You might get a little more discussion on that. I expect stocks to give a return of dividend yield plus stock buybacks and expected earnings growth. This is not a paper on market risk premiums. All right. So I don't need a really long discussion here, but you need some justification for using this approach. This is a huge topic. We got the Barclays article because they had a market risk premium conference. The entire conference was market risk premium. And they published like 1,000 papers. And one of the guys in my department went to it and he brought every single one of those papers back. He somehow got them all on the drive. 95% of them were completely unreadable. They're written by PhD students or whatever. Their goal was that no one would know what they were saying, so you couldn't really scrutinize what they were saying. The Barclay was one of the most readable ones that was out there, so that's the reason I kind of like the Barclay. So the rest of them were just this mathematical garbage kind of stuff that you really weren't practical to use. But it's a very, very important number. So, you know, that's 1,000 articles you can write. And Robert, the reason I'll give you Roger Ibbotson is he does write articles that are readable. He's a very good writer. He knows how to write without overdoing the jargon. All right, so that's going to be my approach. So I need the dividend yield. I'm going to do the dividend yield on SPY. Why on the SPY? Because SPY is the S&P 500 ETF, and that's the market. We define the market as the S&P 500. So that's a pretty easy number to pick up. I think it's like 1.3% last time we looked, wasn't it? It's a ridiculously low number. There it is right there, 1.3%. And you'll know what the word yield means, right? Anytime you see the word yield, you're dividing by the current market price. So it's like every time you see the word margin, you're dividing by revenue. When you see yield, dividing by the current market price. That's true for bonds, for stocks, for real estate, anything. The word yield means you're dividing by a current market price. And it's usually an annualized number. So usually they'll take the last 12 months dividends and divide it by today's price. So it's going to change every single day that the stock price changes. So 1.3%. Stock buybacks. Right here, I'm going to let you cheat. Just quote Ibbotson. Mainly because if you read his article, you're going to find that this is not an easy number to go get. It's really quite complex. You can't just go and take all the stock buybacks and adjust it on a yield basis, because you also have to adjust for stock options and employee plans and those kind of things. So you have to actually look at the number of shares out there. But what we'll do, I'm pretty sure I put this article out here. I'm kind of worried every time I do this, what I actually put out there. There it is. See right there, this is on the miscellaneous materials article, buyback yield. It's again old article because no one else has done this in a while. Was it written 5 years ago, 4 years ago? All right, so they're addressing this issue of, should we adjust our expected return for stock? So this is Robert Ibbotson. This is what he does. He comes up with market risk premiums. What is the risk-free rate? What is the expected return on stocks? What's the historical premium? That's what he does. I don't know who Philip is, but Dr. Ibbotson. So he has a lot. If you don't want to read the article, you can go through and read my highlights. You don't even have to do that. But this is a really key chart right here. For the longest time, the buyback yield was actually negative. Firms were issuing more stock than they were buying back. And so we just ignored it. But then in the 70s, you started noticing that the buyback started growing. And then now it's consistently above the dividend yield. So that means, well, maybe we need to make an adjustment for this. And so here's what he calls the total yield, including the dividends. And then he has a table. You can see how it's not that easy. You need a lot of data. So this paper was not easy for them to run. But they have a summary chart. And there's another. So if you want to update this, then just do everything they did in this article and update it, and you'll be in good shape. But he has a table here at the end. Yeah, that's the right one. That may have been it. All right, so here's the dividend yield. Interaction. All right, so that 150 is the number they recommend that you use. So what they're saying is if you just use dividends, you will be off by 148 basis points versus what you should be using. All right. So you're kind of relying on this one number out of all those pages. So the question is, have buyback yields dropped in the last few years? Have companies changed what they're doing? Some of your firms, you can just see with your firms are still doing pretty significant buybacks here recently. Cash flows are pretty strong. COVID probably undid some of that. I'll go with the 1.5. The nice thing about this is, you know, if your market risk premium is too low, then you got that risk of, you got this low discount rate versus growth rate, and you get these massive stock valuations. So adding this extra 1.5 will probably give you stock prices that are too low, but at least avoid them being radically too high. So it's better to have a $70 stock and you're valuing it at $50 versus having a $70 stock and you're valuing it at $460. So it does help avoid that. And then we have expected earnings growth. So you just have a section on that. And here's where I would probably put the bar chart. Another bar chart I'm talking about. So the history of productivity, labor, and inflation. And productivity. You can use your own numbers, but historically that's been about 2%. That seems reasonable to me. Labor growth. Just the fact that we're coming out of such a an historically low participation rate, and that is not baby boomers. There's something else going on there that if that gets corrected, you know, we should see labor coming back in. But if you want to get really into this, you know, to me, there's some interesting charts. Is it the JOLT? What's the unfilled positions? JOLT or something? I can't remember that. And then you have the quit rate. You know, we have some numbers. Unfilled positions is at a historical high. The quit rate's at a historical high. So we're in an unusual period. So, you know, there's some room for labor to somewhat rebound here. And then inflation, unless Congress kicks out Powell and puts someone radical in there, and I don't know how radical they could go, I'll just stick with that. So that gives me economic growth of 4.5%. What would be reasonable economic growth? You saw my chart, it was what, 5.6% or something? Boy, I can't remember, maybe it was not that. Boy, I should have loaded it already, sorry. It was in my my investment class, right? So let me, I think I put it in your class, but I just couldn't remember where I put it. Tonight, I'll try to remember before I go to another class to save this to your class, just in case. So economic growth has been 6.3%, but that's with inflation probably averaging a good 1% higher. And it's with labor growth averaging probably, you know, 1.5%. So I think you can take off 1% for inflation, 0.5 to 1% for labor growth. So if historically it's been 6%, 4.5 to 5% makes sense. So I think 4 to 6% makes sense. I would find it really strange if you get above 6%. Unless you're just assuming this really massive inflationary thing, and then that's, you know, that's not going to be too helpful. So, you know, I would recommend you not get too far below 4. Just productivity plus inflation should get you probably to 4. Now I realize if you go back historically, real GDP plus inflation, you know, look at actual nominal GDP, it's been fairly weak here the last few years. But going forward, I think 4 to 6% makes sense. Maybe you could get down to 3. 3 is a pretty scary number. So what does that give me for expected return? This Quinius was my typing teacher in high school. She'd be really upset. She saw my typing skills. So 7.3, does that seem reasonable? Y'all know what I was assuming 5 years into my career for stock returns? Anyone want to guess what we assumed as the long-term expected return on stocks? Not 7.3, no. You think it'd be higher or lower? You really think it'd be lower? In the 90s?
Oh.
Somewhat higher, a whole lot higher? Yeah, we were assuming 13, 11, 12, 13%. You just, when you assume 13%, somebody else took my risk management class, you know, a pension plan. It's like, why would we ever put money in our pension plan again? We're making so much money on our pension plan, but 13%. What happens when you assume 13% and you don't get 13%? That's kind of a horrible. I mean, it makes a big difference, right? There's a huge difference. It's not 100% difference between 7 and 13. It's massive because of compounding, and it's a huge difference. So, all right, so there's my expected return on stocks. So what is my market risk premium? 7.3% minus 2.09. All right, now let's see how well you know CAPM. Let's talk about the debate, the risk-free rate. Right? Should you adjust it, not adjust it? So let's say the beta of your company is 1.0. How important is the risk-free rate debate if your beta is 1.0? Think through the formula. You're using a 1.0 beta. How much do you need to worry about the risk-free rate? What's the formula? If your beta is 1, what are you going to get? You can get 7.3%. It doesn't matter. If your risk-free rate is 1% and your market risk premium is 621 and your beta is 1, what is your discount rate going to be? 7.3%. The risk-free rate is 3%, your market risk premium is 4.3%. What is going to be your return? Your stock, 7.3%. It doesn't matter. So this is pretty critical. The debate is about cyclical versus defensive stocks. So who wins or who loses? Okay, so Dan Darren he's using a lower risk-free rate. The unknown Professor Sweet is using a higher risk-free rate. So who will give you a higher valuation for high beta stocks? Whom were they hoping you, what school were they hoping you went to? Higher beta stocks? Which one?
Will give you a higher.
Well, which is going to give you a higher discount rate? I'm going to give you a lower discount rate or higher valuation.
Then there would have higher beta stocks, have lower risk-free.
Well, let's think about it this way. So if he has a lower risk-free rate, what is his market risk premium?
Higher.
Higher. Here, market risk premium is less. Lower. All right, so if you have a high beta stock, what do you want? You'd want a lower market risk premium. So high beta stocks are going to get higher valuations in my approach and get lower valuations of them or them. So that's the only time it matters. If you're defensive, if your beta is somewhere pretty close to 1, it's an academic discussion. It doesn't really matter. Okay. Which is kind of unusual because I don't like high beta stocks. I tend to like low beta stocks. So I have this approach that benefits the stocks I don't really like. But just be aware that what you pick as far as your risk-free rate, if you go with Darren with the lower number or go with me with a higher number, it's going to impact your valuation. It can be material if your beta is above 1.5 or below 0.7. It's probably going to have a a 10–15% impact on the valuation of your stock, all right? So don't get so much into the weeds here and forget, this is academic. It only applies depending on how far your beta is from one. The closer your beta is to one, it's really not that critical to this discussion, okay? All right, so let's go to beta. All right, step one, type of company. Is there much debate on this one? Is this a cyclical or defensive stock? Definitely defensive. So you might think in terms of, okay, grocery stores would be lower, but how much lower? So Walmart does clothing, they do some electronics and other things. That's definitely going to push their beta up a little bit. So I tend to, in my mind, grocery is a 0.4, 0.6. Discount stores to me is 0.6, 0.9. So I tend to think of Walmart as above the 0.6, but below 1. How do I get in that 0.6 to 0.9 range? That's when the operating leverage and the financial leverage come in to help me know where I push that. So Kroger's, I'm probably going to push closer up to 0.6. I might even push them a little higher than that if their debt's really, really out of line versus everybody else. So that's where I'm starting from. And then I go to Yahoo Finance and it gives me a beta of 0.5. That's too low. And it's been negative quite frequently here in the last few years. That's too low of a number. And that just happens to be their beta the last 5 years using monthly. I'm actually surprised it's not even lower than that. Right, so in my table, I'm going to probably say 0.6, 0.9. Target, I'd probably have in the 0.8 to 1 range. What's Kohl's? Well, I don't understand Kohl's. I've only been it once. It seems like Kohl's is a higher beta than Target, but I don't really know. What's the reputation for Kohl's? Is it cheapy or is it expensive? There's no grocery. Yeah, that would be a good thing to bring in. Yeah. So Kohl's is probably higher from that standpoint. I might put Kohl's in the 1 to 1.2. It's not a high price Nordstrom's kind of or Neiman Marcus kind of store. Right. If you're doing Nordstrom's, you do have Nordstrom's, the rack, whatever that thing is. How big is that? That's a lower beta, but how much lower beta? Those are the kind of things you're discussing. So you have a discussion here. Do you try to do any regression? I've had students try it. It's really, really awful to do it. So if you want to take your quarterly revenues and do a correlation to the economics, the GDP numbers, you can do it. But there's so much noise in these numbers. Retail has a lot of seasonality, a lot more seasonality than GDP does. You also have to be careful if GDP is seasonally adjusted and you're using revenues that aren't seasonally adjusted, then you completely got garbage. So I don't think, I'm always appreciate when students try stuff like that. I always like, let's try something, but I doubt you're going to get a good answer. So it's really tough. What some students have done, which I do think can be effective, is say, 2008 and 2020 were good test cases. So how did my firm do in those two extreme cases? Did their revenues just fall off the cliff, or do they stay even, or do they come up some? That could be a good way to address that.
Could you also argue like Walmart data be negative? Because in both recessions, it was pretty good, and it ties in with your normalized kind of deal. Like in the past 20 years, we have been negative every recession. Why would it be?
Well, it's 2 data points. Do I really believe that going forward? I think both of those were pretty unique cases. 2008 was a financial crisis, so if you weren't a bank, your beta came down. 2020 was they just happened to be in the right spot. I don't know what the next crisis is going to be, so it's just 2 points. If you use a negative beta, what does that imply? you'll be happy making a return on Walmart that's less than the 10-year treasury. So that's, I don't believe that. I wouldn't, any of y'all buy Walmart stock. I think Walmart's gonna make a 1% return going forward. 60 basis points with treasury, but that's really good because they're really gonna protect me in those prices. That's gonna be a hard argument to make. I've heard people make that argument with gold and gold companies, but even then, I don't know anyone who's a discount rate that's below the risk-free rate. Negative betas are really tough for us theoretically. I see your point. I mean, it's a really good point, and that's why they've had a negative beta. They've done really, really well. So that might push me down to a 0.3, 0.4 if I'm really aggressive with it, but don't go negative with your betas because it really, you're getting in some really strange waters doing that. But you can certainly have, so you can certainly have that argument. I can't remember what your stock is. Yeah, Chipotle, you won't have that problem. Definitely 2020 was probably pretty horrible for them. So and you have to be careful a little bit because we're talking, noise of your company. There could be a reason why they did badly in 2008. It had nothing to do with the financial crisis. They just did something else. So there is that systematic versus unsystematic issue. But you might do that if you wanted to. So yeah, Walmart did exceptionally well in 2008. They did exceptionally well in 2020. But does that mean they're really a negative beta company?
So for Netflix, I mean, I think it's a good company, but if you see the numbers, it's quite low.
Well, COVID was really an unusual case for
Right,
them.
so I still put it over one, but I read it that it's like 0.7, 0.8, 1. It should be above 1, but I can't.
Most people think of a Netflix as a consumer discretionary, but it's a consumer discretionary that people don't give up on. It's one of those things. It's a cheap way. The thing that's amazing to me is that people still buy cable because cable to me is so ridiculously expensive, and Netflix, so it's a cheap alternative. And people don't normally cancel cable during a recession. It's one of those things you just keep going and keep going. We were helping this one lady in financial distress, and we were actually paying a lot of her bills, and that's one of the things. I'm keeping my cable. It's like, yeah, well, we're paying your bills. It's like, no, I'm keeping my cable. So you think through those kind of things. Is this something people will cut back on? So will they cut back on it? Netflix before they cut back on electricity? Probably not. But those kind of things you have to ask. I could see Netflix below 1, but I can also see it above 1. Netflix is kind of in that gray area. It's definitely consumer discretionary, but it's a consumer discretionary. It's not all that particularly expensive, and it's becoming the norm. It's taking over. So the fact that they're the most expensive now and all those kind of things, you have to kind of take that in consideration. Yeah, it's not easy. Not all of these Walmart, I picked a firm that's pretty easy to talk about, but it's not always that easy. The second one is operating leverage. All right, so here I'm going to argue, hourly wages, pretty constant margins. So that's going to argue to me lower beta, lower range. So you see kind of how I do this. On number 1, I establish a range, and then 2, 3, and 4, I somewhat move within that range. So I think this is a defensive company, but I also look at the operating leverage, and that pushes me closer to the lower end of that range, maybe 0.6, 0.7. I'm kind of trying to get in closer and closer to what I want. 3, financial leverage, I'll have to look it up, but I'll show you the chart. So let's look at the chart. Okay. Right. I'm not doing well with Blackboard this year because I can't remember where I put anything. There it is. No, there it is. Okay. So this one is on their class models and templates. Maybe I should just put these files in every directory. You can find them. But data for Bloomberg for relative financial and operating leverage. All right, y'all see that? It's in your Blackboard too. That's pretty amazing. So it's in your Blackboard. So I'm going to open this file. I updated it, I think in August, so I've got as current data as I can get. So let me do this for Walmart. So all you do, and then the directions up here, you just do equal and go to the pace values and you just find your stock. There's a lot of companies. Right there, there's my stock. All right. And then you can just bring this into your paper. I would clean it up some. I'm not going to. I'm just going to bring it in. All right, so what does this tell me? So there's a few things here. So let's start with operating leverage. I give you gross margin and net margin. You only really have to talk about net margin, but I like to look at gross margin. So here's my theory. This is my theory. I haven't seen this. I've never heard Dan Darren talk about this. So I don't have him supporting me here. But my argument is a firm has a lot of operating leverage, a lot of fixed costs. It should make their margins more volatile. That's my theory. Okay. And so what I do is I take the US stock market and I get their standard. This is not their gross margins. Walmart's gross margin is not 1.21% or they'd be out of business. All right. This is the standard deviation of their gross margin. This is the standard deviation of the gross margin of the US stock market. And I give you the range. So Walmart ranks 14%. They're one of the lowest out there. Very stable gross margins, which you would expect for this type of discount store. Their net margins even more so. Their net margins, you would expect net margins to be more volatile because that's where the depreciation is and all those other marketing expenses. But their net margin is actually more stable, 0.51%. They rank in the top 10% or even better. They're one of the lowest ones out there. All right. So I'm going to argue very low volatile margins. This argues for lower end beta. All right, so that's my theory. Now, when you do this with other companies, you get some surprising results. So if I did this for Ford, you say, wow, Ford, that should have a really volatile net margin, but they don't. They have a low net margin. Well, that's because a huge chunk of Ford is Ford Motor Credit. When you're a bank and you have these margins, these interest margins that are very stable, it makes your earnings very stable. So you can't always trust the numbers, but this makes a lot of sense. All right, so you can just bring this in and talk through it. This is what I was saying is, if you have some key competitors, 5 or 6 key competitors, I think it'd be really interesting, not just to do your company, but bring several companies in and maybe do a chart. Where's your firm's volatility of margins versus the key peers? It'd be really easy to do. You got all the data there. You could just write down the numbers, build a chart, and you would have it. You could have the overall market, and you have your companies, right? So I could bring in Costco, I could bring in Target, Kohl's, I could bring all those in, get their numbers, and see where they stack up. I could do the exact same thing for debt to equity as well, right? I think I've had like 2 students ever do that, so no one ever does it. So I think it'd be really, really interesting. All right, when we look at the debt to equity, where did they stack up? They're slightly above average, okay? Slightly above average, but not enough to change beta. It's just not that radical. But has a Y in it. All right, so you just have these discussions. It's usually 1 to 2 to 3 paragraphs each, depending on how much you want to get into it. The operating leverage is where students lose the most points because a lot of students, all they do is they get this number here and they say it's low, so my operating leverage is low. You need to have that kind of subjective discussion as well about what your company's all about, what's their costs, do they have R&D, do they have marketing, do they have salaried employees, have that discussion as well. But you can bring this in and you can get some extra points if you do a little extra analysis comparing to other companies or finding some way to kind of stack up your company versus this industry. And that would really help you, right? We're saying, well, this industry, discount stores, is definitely a low beta company. But wow, Walmart, their margins are, even in that industry, their margins on their low end as far as the volatility. Now, do be careful. I will count out for this. Walmart has very low net margins, thus their op leverage is low. What's wrong with that statement? Yeah, you got to say it has very low volatility of net margins, all right? So you're talking about the volatility, the standard deviation of the margins. It's not the margins themselves. So be really, really careful with that. So if you look at some companies, I always love showing Costco because they're so off the charts versus everybody else. That's the reason I'm doing Costco in my forecasting class, because they're one of the easiest to do. Yeah, their net margin, I don't know who's ahead of them, but their net margin 0.2%. Doesn't even show up. And you can definitely see it in the numbers. There's their gross margins. What are you going to assume the next few years? Somewhere between 12.5% and 13%, right? Pretty obvious. Here's their net margins. Which is, even if you put some decimals to it, you know, I'm kind of lying here without having decimals. But even with decimals, it's amazingly stable. This is not a difficult company. So the two of you doing Costco, if you come up with a net margin of 7.3%, probably gonna be like, where in the world do you get that number? And everybody knows this number, 3%. It's just, everybody just knows this number. That's Costco's margin. You compare that to a Tesla, here's their gross margin, 88%, negative 8%, 26, 37. They're starting to get a little more stable, but not all that much. Still pretty volatile, but their net margin, I don't even know what that number is. Wow, they got a positive number, 6%. Would you want to forecast a Tesla? It's getting kind of rough, right? It's getting easier, but it would be a rough company to. And there's their standard deviation, 30,000%. Here's another company, 6,000% standard deviation. I don't know who that is. So, you know, you bring in numbers, look at them, see if they tell you something about the company. I'll do a couple others here. I'll tell you what I'm going to do. Do FedEx because I'm kind of. So what would you think before we look? FedEx, a lot of fixed costs because of depreciation, heavily unionized workforce. They have some variable costs related to fuel, but fuel prices going up or down. You know, they're going to have to still deliver, where they increase their prices when fuel prices go up, and those kind of things you're looking at. So if you bring FedEx in, they're actually more stable than I would think. And you see that a lot where firms are just a lot more stable than you would think, but pretty stable margins on the net and on the gross basis. Now the gross margin, you don't have to actually talk about. What I think about a gross margin, that's where I think about elasticity of demand. How sensitive are their customers to price changes? And if they're very sensitive, you should see a much more volatile gross margin. Now, the argument there would be, if I bring in a Philip Morris, you would think that'd be really stable, right? Because their customer is going to buy their product no matter what the price is. So let's see if that's actually true. Getting close. Yeah, pretty low. Not as low as Costco and Walmart, but pretty low there. All right, so what you're doing in this part of the paper is going through that. The debt to equity, you don't have to do more. So debt to equity, you just look at the numbers. So I'm not looking for discussion unless you want to bring in other companies in your competition. mean, if you're gonna do it for the margin, you might as well do it for the debt to equity and just have the exact same chart again. Right? There's no reason, you already got all the data there. All right, and then number 4, what was number 4? History. So I'll do that next. This is the thing I do that every other professor here is like, why does Sweet always do that? So I think it makes a lot of sense. The other professors don't like it because they don't, you know, they don't like you questioning CAPM. You're supposed to go out of this school thinking CAPM is sacred. I think it has a lot of problems. I know they talk about the problems with it, but they don't want us messing with beta, because if you throw out beta, you kind of, you know, as they say, CAPM is the worst model out there except for all of the others. We don't really have anything else to go to. So I'm not trying to destroy CAPM. I actually think CAPM is a good model, except I just think beta is a number that you forecast. It's not a number you pull out of, you know, out of history. So, so we'll look at the history next. So, all right, I'll stop it there.